Hi, Jason Moser here, analyst with Motley Fool One, and thanks for joining us for another edition of Ask a Fool. Today we're taking a question from Twitter, and @Mike K. Brown asks, how much do you take dividends into account when investing? I've found that the older I get, the more I appreciate them. Well, that's actually a really good point there, Mike. I think as the older I get, the more I appreciate dividends too. And I think that dividends can be wonderful indicators of the types of companies in which we're investing. Companies that pay steady, consistent dividends and are able to raise those dividends over time typically have a business model that's able to generate consistent revenue and income. And this also tells us a lot about management's takes on shareholders and where their priorities are. A recent study actually by Ned Davis Research shows that from 1972 to 2006, S&P 500 stocks not paying a dividend returned just 4.1% annualized, whereas dividend payers actually returned a whopping 10.1% annually. So you can see that dividends can definitely make the difference over time. That's like magic of compounding that we always talk about here at The Fool. So I like dividends a lot, but I don't base my buy decisions on whether a company pays a dividend or not. Further, I'll take a look at dividend payers, a look at their payout ratio, and that tells us basically how a company can afford their dividend. It takes the company's total dividends paid for a given period divided by the net income for that period, and it's expressed as a percentage. We like to see that number lower. A higher ratio means the company may have trouble affording or sustaining that dividend. You can also see in times like today, where investors are chasing yields and the stock prices of these dividend stocks can get bid up. So you need to be aware of stock valuations as well. And also remember that there were a lot of people in the financial crisis. When the financial crisis hit, they were dependent on those banks' dividends as meaningful income. When the financial crisis hit, those dividends disappeared and those investors got hurt really bad. And I remember personally speaking with people who actually gave me numbers that they were dealing with. And it was a solemn reminder to me that diversification is definitely the key to long-term success, dividends or otherwise. So at the end of the day, it's nice to see dividends, but I definitely don't base my buying solely on that. But it's a great question. I appreciate you asking it. And for more information, make sure to check out Fool.com.